All right, dope. Wow. Hold on. We're having technical difficulties here.
Yeah, there was something going on with the intro.
It's me. It's me. Hold on. Everybody, hold on. Look, for some reason it got me twice. Hold on, though.
There's
It
something
is
high pitch
acting
sounds in the
up.
background too.
How about now? Nope. Hold on. Sorry, everybody. Hello, testing. Okay. Hey, dope. You are live, so you can talk. So don't mind me. Go ahead and open up the show. I'll get this
Okay,
straight.
yeah, my man is having some trouble over there, but we'll go ahead and get started. The we usually start off talking about the stock market, and that's what we'll get into first before he joins us. And really has been a stellar month for the stellar quarter. I'm sorry, for the market, and there was so much negativity going into this year with everyone thinking that the market was going to hit a recession and things were going to get really, really bad. But again, this has been a great quarter. The Fed has seemed like they're okay. Looks like they're going to be able to achieve their soft landing, which was to bring down all the crazy inflation without putting us into a recession. And so, I mean, S&P had 22 records so far this year, and the economy looks like it's in very good shape. And even though there is still some talk that the Fed is in no rush to cut interest rates, we'll wait to see tomorrow. I think they will be analyzing some data that comes out tomorrow. It's going to give us a little better idea of where we are as far as the market is concerned.
Hey, Doug, can you hold it for a minute?
Okay.
Okay, so you can hear me fine?
I can hear you fine.
Yeah. Sorry, apologize, everybody. You know, modern technology, we have slaves to that. So, thanks, Doug. You can continue. Just want to make sure.
Yeah, I was just getting into the stock market update and just talking about the quarter because the market's closed tomorrow. So this is essentially the end of the quarter. And the S&P ended up, it topped 5,250, and that's a 10% rally for the quarter. Now, this is kind of a, looking back at history, S&P has only gone up over 10% 5 times since 1950. So what does that say? It says that it may happen again and be the sixth time, or things may actually go down a little bit. And so we'll have to see if that happens. But very, very good quarter, month. This year has been fantastic, and we'll wait and see what the Fed does after they get the news tomorrow. So, Bob, you can go ahead and do your normal intro, then we can jump. Oh, okay, you already had it up. We'll jump to the stock market update now.
Yes.
You can see for the week, Dow is up a couple percent, Nasdaq's up almost 2%. And my own stocks that I love, Microsoft's down a little, Tesla kind of recovered a little bit, but as I've always talked about, Tesla has been extremely volatile. Apple's down a couple. They're still facing very, very poor sales in China. It's like China's trying to squeeze them out, and there's so many people over there. That's a huge market. Pfizer's pretty flat, and NVIDIA continues its growth. It had been up way higher than that and actually came back, and then it went up again. So it's becoming more volatile, and people are starting to wonder if it's reached its peak. And we talked about Google. This is one I jumped in even more a few weeks ago. I got in too. So it's going pretty good right now. It's up 8 points for the week, and that's almost 6%. So I'm hoping it'll keep going the way it's going. So for me, this has been a great week, a great month, a great quarter. things are all going in the right direction. But who knows what's going to happen when the Fed sees the data tomorrow? It could all go the other way. A lot of people are thinking the market's overvalued and that it's due to a correction, but who knows? And as we always tell you, you're in this for the long haul. You get caught up in the short term volatility that's bound to happen. It's always going to be there. So, all in all, a very, very good week.
Wow, this is some weird stuff, though. It's acting on today, but
It sounds like you got little birds in the background.
yeah, it sound like and sing. So anyway, that's the stock market, and as you can see, the video is still rolling, dope.
I love it.
I'm telling you. So let's talk about cryptocurrency. Last week it was down over $6,000 for the Bitcoin. This week it's up $5,386 per Bitcoin, marked at $70,857,000 a Bitcoin, up 8%. The total cryptocurrency market is over $2.7 trillion, up $100 billion. So people are jumping back in. They're getting enthused. I'm looking at Dogecoin. Dogecoin went from number 10 to number 9. It's up 40%, 47%. I don't know what the dog coin is doing, but the Dogecoin is moving up. And so is, remember we were tracking Shiba Inu, though, and it dropped all the way to 18. Shiba Inu is all the way back up to number 12. I don't know what's going on, but that's what they call that meme, M-E-M-E coin. And it's moving. Don't know what does it, but it's all about consumer sentiment. And Solana is up another $12, 7% up to $189 since we've been tracking it. So to all you cryptocurrency holders, for the people who got in 2018, you got to be doing well. And for the people that got in 2020, you actually probably just been brought back even. So everybody's boat should have rose the last couple of weeks with the cryptocurrency as a whole. But as we always say, we deal and track the top 10 cryptocurrencies because those are the ones that seem to be a little bit more secure than most, if I can really say that word secure. I just mean more secure than most. But the Bitcoin is still the number one coin, and it's still holding. Matter of fact, though, they're talking about what they call it. It is what's the term? It's called split. It's not called split. Halving. Yes. Because only that was the thing with Bitcoin. Only 21 million were mined, could be mined. And they said at one time it's going to take, up to 20, 35 and it's up to 19 million that are out there, right? That are in circulation. And they talked about halving, and that's supposed to make it, which makes it more attractive because mostly like Dogecoin is over, something like, 2 billion. 2 billion that are out there, Other ones is like 400 million cryptocurrency, different cryptocurrencies volume. But that's supposed to make Bitcoin so much more attractive. It's limited, and it should be, it's all about supply and demand, right? So we'll see. But with that, I like to just back up for a minute and officially open the show today. We had technical difficulties, and welcome to the FITT Show, financial information for today and tomorrow. I'm Bobby Kinzer, and that's Thomas Doty. We always are here. This is our 143rd show, and we are providing information to help people grow their wealth. And we're hoping that last week we talked about should you buy a car, and we hope we answered that question for you. It was a rhetorical question because everybody's is different, and if you got a car, no car lasts forever. But it was another good show. But though, let's talk about this week. And before I go any further, please click on the like button because that helps us get traction, and the heart button. And when you put comments in the comment box, that helps exponentially. But we like to use the comment box as our way to interact with you. That's how we can interact with you from our virtual studio. So if you have comments about anything we say, questions about anything, or your own opinions, or you have some other topics that you'd like discussed down the line, put them in the comment box, please, you all. We look forward to that. But though, you know, it's a million different one investments out there. But you know, a lot of investors, make mistakes, and sometimes the same mistake time and time again.
Yeah, and whether you're close to retirement, whether you're just starting off, you just can't afford to make some of the common mistakes that we're going to talk about. They're like basic investment blunders. And if you look back through history, we've had some crazy things happen, whether it was the dot-com crash in 2000, we had 9/11 terrorist attack, 2001, housing market collapse in 2008, and we had the crazy coronavirus pandemic, and all those things took a toll on the market. And over the past 2 decades, there have been all kind of crazy financial, political, social, all kind of crazy things that have happened. And they're going to keep coming. We know that. It's something that you can't predict. No one knows what the next catastrophe is going to be. So whether you're close to retiring or you're just starting off or you're somewhere in the middle, there's some things that you need to be aware of. The fact that there's always something coming, but we're going to talk about some of the things that you should definitely try to avoid.
Yeah, and even though these events have rocked the U.S. and even the global, economies, we may look a little different every time, things change, but the stock market volatility is normal. And I know a lot of people are afraid. They look at investing in the stock market like gambling, like going to the casino. But there is a big difference in investing and in gambling, because investing is for the long haul, and there's fundamentals that you can follow that can prove it over time that you can grow your money, as opposed to the crap table and playing blackjack. But it's something we always should be aware of and prepare for. Yet we see investors make the same mistakes time and time again, Dope. So won't you start us off, though, with some of the mistakes that investors make with their investments?
Yeah, and the first one is just the thinking that things are going to continue as they are today. And that could be, you could get to thinking there's not going to be any volatility. You can start thinking there's always going to be volatility, so you shy away from the market. But sometimes people want to get that little extra out of the market when there's a bull market, and you just really don't know. One thing we know is there's going to be some type of volatility. We don't want you to get caught up in thinking that things are always going to be as they are today. So that's what you can't worry about. You can't get caught up in that. You just have to be cognizant of the fact that things are going to change. And if you're a younger investor, plenty of time to rebound, you can obviously take more risks and expect things or not expect things, but you can have a longer term view than somebody who's closer to retirement. But just don't get lulled into thinking that things are going to stay the way they are, whether they're low volatility, crazy volatility. Over time, things are all going to even out.
That is so true, Dope. But let me tell you, another one that seems that the people can avoid is like, a lot of people try to time the market. And we've talked about this before. And trying to predict the market's movements is best left to professionals. And look, most of them are not even great at it, though. I remember when I was a stockbroker back in the 80s, man, they had this little study done where they took the Wall Street Journal and the stock portion, and they had four top financial advisors in the country, and they picked stocks, and they had two monkeys that just pointed at stocks on the paper, and the monkeys outdid the professional advisors. Not to saying the professional advisors are not good, but it's just that hard. I mean, nobody's that good that they can actually predict the market. An average investor loses over thousands and thousands of dollars a year because of bad decisions, and about when to get in and when they get out, and often because their emotions get the best of them, and they forget the fundamentals. Because we talk about the long play, we talk about knowing your time horizon, we talk about having goals, we talk about knowing your risk tolerance. Those are the fundamentals. But an advisor who's looking at out for your best interest will tell you that sticking to a plan based on your goals, your time horizon, and your individual risk tolerance is the better way to go.
Yeah, and piggybacking on what you just said, the next big mistake people make is taking too much or too little risk. And we've always talked about you have to understand your risk. And that's going to help you sleep good at night. That's going to help you not get too high and not get too low when you understand your risk assessment, and you can translate that either to your advisor, or if you do it yourself, to your own investment plan, because you'll be satisfied with the amount of risk you have in there, and you'll be expecting certain things to happen. You'll be prepared for certain things to happen. So if you're looking for guaranteed income, and you have to understand that if you accept less risk, your return will be lower. And if you're happy with that, then more power to you. And that's the thing you got to be comfortable with. And that's an individual situation. That's not something you can get from somebody else, or you can have somebody else tell you what your risk tolerance should be. Somebody could give you like a framework to say, okay, if you're very young, you should be accepting a lot of risk because you do have a lot of time to recover if the market does take a hit at that particular time. And as you get older, someone in general could say you might take less risk because you don't want to put at risk what you have grown or whatever wealth you've built. And so, but again, those are just guidelines. Everybody's individual situation is different because everybody's time frame is different. Everybody's expectations are different. There's so many personalized things that play into setting up your own risk level. You have to do that. You have to understand what that is. And if you're working with a financial advisor, you have to be able to get across to him so he can serve you to the best of his ability or her ability.
Or he, she, it, and the dangling participle. So
I'm not going there.
so though for a minute, I want to stay on this because it says too much risk or too little risk. I find most of the people I know, they take too little risk, man. It's very few people that I really know that take the real big risk. Now I've noticed the younger people, and they say, younger people are into cryptocurrency, day trading, and options and stuff like that. And those are definitely way more riskier. And they try to say that the young people are just because they want instant gratification. But I talk to these young people, and it's not that. They just see the benefits of using those as any other tool. You know what I mean? It's just that they, but they're chastised for, because they trying to get rich quick. But I talked to a lot of young men. They said no. They see the fundamentals, both fundamental analysis and the technical analysis on how to be able to track and make money doing that. So I don't really try to denounce anyone, whether they want to take high risk, medium risk or low risk, because it's your personal choice. But I do know that a lot of people are afraid, especially black people, though, they just don't take risks. And it's been shown time and time again. So I just hope we get better at that.
Yeah, and on that same path, as far as looking ahead and taking risks, you have to understand implication of taxes, whether that's next year, 5 years from now, 10 years from now, retirement, whatever the case may be. And most people only think about taxes between January and April 15th when they have to get them done. And as your wealth grows, your tax bill usually grows. As your situation changes, your tax situation changes. And there are things you can do early in life that can affect your taxes 20 years down the road, whether it's doing a 401k and deferring taxes or saving on a pre-tax basis. you still have to have a plan for how you're going to deal with that when you retire, because at some point you're going to have to pay those taxes. And so when you talk about tax planning, in a perfect world, you do your tax planning for next year. You'd also be looking at 5 years down the road, 10 years down the road, 15 years down the road. And we've always tried to stress the point that building wealth is complicated. It takes time. It takes expertise in a bunch of different areas, whether it's buying, selling stocks, whether it's researching stocks, whether it's estate planning, whether it's your tax situation. If you don't have that expertise, you need to get it. And a lot of people don't want to spend whatever it takes when that person, if they're good at what they're doing, can save you way more than that over your lifetime. So taxes is a big one that people overlook, and they pretty much just deal with it as it comes along. But it's something that you should plan for, be prepared for, have a plan for, and make sure you are in a good position now and in the future.
Right. So you talked about knowing the impact of future taxes, right?
Yep.
So no, people don't know that the Trump taxes expire in 2025.
Right.
So we don't know what's going to be happening with the taxes, because that it expires next year. I mean, people don't even know that, and people need to start preparing, getting themselves in shape. But though, let me tell you another one, man. Let me tell you another investment mistake that people need to avoid. They think they are truly diversified. Now, we talk about being diversified all the time. We talk about that all the time. But some people think they are diversified, and they're really not, because of portfolio diversification, allocating money across many asset classes, geographically, regions, and sectors can help with avoiding disaster in a downturn. But if one stock tanks, others in the different classes might not be hit as hard. But many investors, though, this is the misconception. They believe they're keeping their money in two or more mutual funds solve that problem. But they aren't necessarily getting the diversification they need if those funds hold the same similar stocks. Because I know people that have two different mutual funds or ETFs, but they in tech stocks. So you're not really diversified. You got two different stocks, two different securities, but they're not that as diversified as you need to be. And your investor, or you could audit your investments to avoid overlap and to make sure you aren't overly allocated to any one thing. Even if it's something you love, like a Nvidia stock, like Doge, or Apple stock, or precious metal, real estate, or even the company you work for, you can't be diversified enough, I don't think.
Yeah. And the next one, we've kind of beat to death, and we feel this need to, but just editorial. Again, we have no skin in this game. We aren't recommending anything. We're just trying to give advice on what we think is the best way to approach financial literacy. And so the next one is a big blunder people make. I touched on it previously. Is putting off getting professional advice. If you equate it to your car, when people used to change their own oil and do their own spark plugs and all that kind of stuff. The cars have become so complicated that most people don't even bother that stuff anymore. It's no different when you think about all the complexities of your financial life, whether it's investing, which can be complicated, even though you can kind of get rid of that by just buying broad-based mutual funds and dealing with the risk that way. But when you add in all the other things, the estate planning, the tax planning, the how to pull out money, how to use money, how to invest it, there's so many different aspects of this. And tax laws change quite often. As Bob mentioned, the Trump tax cut is going to expire, so there's going to be either that'll be extended or there'll be a new whole new tax plan. If Trump's not in office, there'll be something different that you'll have to get behind and know and understand. The way the tax situation is tied to how you pay your Medicare. All that will affect your financial wealth. And little changes you make, whether you're 10, 30, 40, 50, or even if you're 60, they can affect you for the rest of your life. And there are some situations where you need to get financial help, professional help. And a lot of people won't get a will because they don't want to pay a lawyer. And then their people who are left end up dealing with probate. And if you do have any wealth built up, it gets cut back by having to pay lawyers instead of having everything laid out. So you don't have to pay that. And that's money that could go to your heirs as opposed to going to some lawyer. So if as complicated as it is, if you think you need help, go get help and do the due diligence to make sure you get someone who's going to help you, who has your best interests at heart, and who's going to make sure you make decisions that are best for you over your lifetime. And when you start thinking about over your lifetime, a little bit of savings can have a profound effect on how much wealth you build. And by the same token, paying small amounts of money to get the professional help you need that can, help you make more money over your lifetime can also have a positive effect on your total wealth.
And that is so true, though. I want to talk a minute about another one that investors are more worried about gains than managing risk. And let me tell you what I'm talking about that. Investors are trained to concentrate on accumulating as much money as they can for retirement. We get that. But when you're closing in on the finish line, accumulating could cede the spotlight to preservation, meaning that means moving away from risky investments that are vulnerable to the market's unpredictable movements and toward a distribution plan that focuses on establishing enough reliable income to cover your monthly bills. For instance, if your Social Security and pension payments won't be enough, you'll likely have to fill the gap with withdrawals from your savings. And if the market just happens to blow up right before or after you decide to retire, you haven't protected enough money, and your retirement could blow up right there in front of you, with that. So sometimes just don't focus on the gains because some people get greedy and, they keep want to take the high risk. And I get it, but you need to manage your risk. As we talk about risk tolerance, it is so important, but you got to learn how to really, really manage that risk. The last thing I want to mention about, though, were you going to say something, though?
No, go ahead.
Last one I want to mention, and this is we talked about this too, but some investors hoard too much cash. Now you probably think that retirees have seen enough to be emotionally stable about weathering a crisis, right? But that's far from true. Markets tend to go down more than they should because panic sets in. Now, anybody actively invested in 2008, they probably remember hearing about all the retirees who sold out in fear, locking in losses as they watched their resources shrink and they panicked. But holding on too much cash while anxiously awaiting the next market crash is another mistake that investors often make. The problem is the older you get, the more likely to rely on dividends and interest to grow your balance. Cash provides neither of those benefits, and it has to be used to create that sort of growth that you need to get dividends and interest. Now, making drastically changes to your investment portfolio, like moving most of all of your investment accounts into cash, I mean, that's a personal decision, and you may feel like that's a safe decision now, but such emotionally driven decisions are almost never a good idea. It's important to have a long-term investment plan that you can stick with through the inevitable ups and downs of the market. Otherwise, you'll be subject to the whims of your emotions, which often leads to buying stocks near market peaks and selling near bottoms. So market bottoms. So be aware of that.
Yeah, and Bob, that's another thing. If you have the right professional, they can talk you off the ledge, so to speak. They can give you their knowledge, which and data that shows you that you should not be reacting to panic. You should not be reacting to, and I say panic, it could also be euphoria when things are going up like crazy, because things aren't going to continue to go up just as things aren't going to continue to go down. And that's where another place where if you don't have the financial expertise, someone who does can give you a well-rounded overview, can show you history, can show you trends, can show you things to keep you calm when things are crazy, and at the same time keep you grounded when things are going up like crazy. Because a lot of people, when things are going up, they think that's going to continue forever. And if you really study the market, look back at history, you find that the stock market either goes up all the time or goes all up all the time. But what we've told you since we started this show is over the long haul, the S&P 500 has averaged, or the market, so to speak, has averaged 9 to 10% a year. That's a fact. That's not up for debate. And there's been a lot of peaks and valleys within that. And if you're making decisions in those peaks and valleys, you're probably not making real good decisions. But if you're invested for the long haul, you're pretty well diversified, you're going to do okay.
Hey, so and I want to make a last comment about holding too much cash, because if you like holding if you're holding too much cash, the worst part of having too much cash is you're actually losing your buying power every year because inflation erodes the value of your dollar. So I just want to make that point. Modestine has it's a statement. I don't know if it's more of a question or statement, but it says a trust is better than a will, in my opinion. And Modestine, um, I'd like to know why you think a trust is better than a will, because you're actually right. Because
Oh, question.
a will can still go into probate in certain states. A will
Yeah,
can still go into
she's
probate.
absolutely right. A will is the minimum. If you have any kind of will build, or if you have any kind of property or any assets that you have, a trust is always much better. And
Right,
no question about it. And a lot of people shy away from those because they typically cost $1,000 to $5,000 to get done. But
right,
they can save your heirs a whole lot of effort and a whole lot of money. And there's some things you can avoid if you have a trust. So she's absolutely right. But at a minimum, I mean, kind of like a will is kind of the baseline. So
right.
what she's saying is absolutely correct. And a will, a power of attorney, and a health directive are kind of the minimums. And if you get a trust, you pretty much got all your bases covered.
Yeah, that's what I was shocked though that a lot of people don't know. It depends on states too. Like I said, certain wills can still go into probate. The state can make the can make have it go into probate and delay it. The trust is straightforward. It goes right to what the requirements say within the trust. So yeah, that's a good statement that you make, Modestine. So true. So dope. With that, let's talk about the summary and takeaways from today's topic: investment mistakes to avoid, because there was a lot there. So you take it away, dope.
Okay. And the first, we've hit on this during the show, and we've hit on this. Hopefully, every show we've done, we've talked about this. And it's to take the long view. You don't react to short term market situations, because there's always going to be something that happens, whether it's good or bad. You have to look long term. You have to understand your time horizon, what you're trying to accomplish. And if you can focus on that, you won't make any rash impulse decisions.
We can't say it enough. You can't time the market. Like I say, some of the best of them try, and it's a no-win game. It's all about you having the long play, you all. It's all about dollar cost averaging with me and Dope talk many a times, where you consistently invest, if you just have the same amount, consistently invest that same amount every month. If the stock goes up, you may pay higher, but if the stock go down, you pay lower. And over time, it averages out that you end up getting the cheap stocks at a better price. And it's called dollar cost averaging. So that helps when you're trying to time the market because you really can.
Right. You got to understand your risk tolerance. That's something that cannot be understated. You have to know what risk you're willing to accept. And again, that's going to help you sleep good at night. You're going to be comfortable when things go down. You're going to understand that it's not the end of the world when things go down because bad things are going to happen. I rattled off three, the dot-com crash, 9/11, the coronavirus. Things are going to happen that affect the market. But typically, those are short-term situations. Recessions are going to happen. Bear markets are going to happen. And they always have. And the market is always recovered. But you got to understand how much risk you're willing to live with, that you're comfortable with. And there is no right answer. Bob's answer is right for him. He's a little more conservative than I am. My answer or my risk level is right for me. And it's not something you can get from someone else. It has to be how you feel, how much risk you're willing to accept, and you got to understand your risk tolerance. That's a fact.
And lastly, you got to realize when you need help. That is just so important. Um, Doe talked about a financial advisor. When we say help, it just doesn't necessarily mean a financial advisor. We hope it's, it could be somebody, a friend who's really astute. It could be reading a book. Try to get as much help as you can. Me and Dope, by the way, full disclosure, a lot of substance we get from the Kiplinger, and that's online, and it's such a great tool. Then it's so many more. Yahoo Finance have articles. There's so much information that you get that can help you. So don't be afraid to get that help. And first of all, realize when you need help. That's what most people don't realize. They wait too late, and then I mean, when I was a broker and a financial advisor, they wait until they were deep in the hole and then come to me like I was a savior. It was always tough.
Yeah, and Bob, we don't want to get the impression that just because you get an advisor, you can kind of wash your hands of everything. Building wealth takes time, takes effort. Even if you have an advisor, there's still some things that you have to understand yourself, and you have to be in a position to assess the performance of your advisor to make sure that he's doing the things that you want done. So there is no easy way to build wealth, and one of the basic premises is you have to be knowledgeable. You have to, and what you don't know, you have to find someone who does know. And even with that, you still have to do some work to stay on top of your own situation. And it's one of the things we always say, you got to find out what you don't know and then make sure you know what it is you don't know so you can address it. Because
and when I'm glad you brought that point up. You need to know, at least some of the basics of your finances, and you definitely need to know what your goals are. No financial advisor can tell you what your goals are, but as far as knowing the technical information, the strategy, and all of that, you don't have to have have no finance to be to do that. But basically, there's about 8 questions that you should be asking a financial advisor, and not just a financial advisor. Any stockbroker, even yourself. Whenever you go into purchasing a security, you need one of them is this product registered with the SEC or a state agency? Another question: does this investment match my investment goals? Why do you feel it's suitable for me? Another question you could ask, an advisor: how does this investment make money? Is it dividends? Is it interest or capital gains? Now, some people say, wait a minute, interest and capital gains, yeah, they are different. They're definitely different. And you need to know, how is your investment going to make money? How about another question? What is the total fees to purchase it? Not just commissions, but any underlying fees as far as, expense ratios and 12B1, the marketing fees, all those things you need to.
Admin fees. Yeah.
Admin fee. These are things you need to, you need to know yourself. But if you have an advisor, these are the questions that they should be able to ask you, because if you're investing, this keeps you from avoiding making some of the mistakes that you do. For instance, is the investment liquid? Are there any fees associated with assessing your money, assessing your cash? Is it liquid? Is it penalties for early withdrawals? Can you tell me about the management team? Many companies tout past performance, but they may come from a team that isn't there anymore, right? And how about this one? What is a reasonable return to expect for my investment? Now, nobody can tell you precisely what is going to return, but they can give you what is the reasonable expected return for an investment. And you should look at that yourself. You should always look at the 1 year, 3 year, 5 year, and if it's been around longer than that, the 10 year. But we do know past performance is no indicator of future returns, but at least look at the reasonable expected returns and how has it performed over the long run. I mean, don't always talk about that. Yes.
And they might give it in terms of a range.
Right.
If the market does well, if the market does poorly, this is what you can expect. And to Bob's point, you have to make sure you understand how you're going to grade their performance. What benchmarks do they use? What's expected? And then understand why they didn't achieve what's expected. And again, there's so many variables that make up what happens in your market performance. But you've got to understand how you're going to assess their performance when you start. You and them have to be on the same page as far as how their performance is going to be assessed.
Right. You don't want to make that mistake where you don't ask the right questions. And many money managers who highlight performance, they do after a great year. They tell you that after a great year. And if you are a long-term investor, that might not be meaningful to you. And the last one that you consider, asking, and you need to know this yourself, is what are the risks associated with the investment? You need to know that, and we talk about this all the time. Know what you're getting into. Whether you relying on an advisor, investment advisor, or you finding out yourself, because you need to know what could cause it to lose money. And those are just the kind of questions that you can ask to avoid you from making investor mistakes in the long run. So just wanted to share those with you all. And as always, I thank everybody for tuning in. And Garnett says, knowing who you can trust. Oh, yeah, no question. You need to know, and that's a tough one, but let me tell you about the financial advisors, because they need to be registered for one, and they need to, in that way, they have a fiduciary responsibility. And any financial advisor that say they're registered, and if they're selling any products to you, they have to have a Series 7 or a Series 6 or a Series 65. They need to be registered. And how you can find that out, because you just can't take everybody's word. We say, trust but verify in the accounting business. You can go out on FINRA, FINRA.org. It's a government, and it's not a government. It's a nonprofit. That particular is nonprofit entity, but it tracks all mutual funds, the reliability, the registration of mutual funds, and the registration of financial advisors. So if you ever get one, you can look them up under FINRA. That's the Financial Regulatory Agency, FINRA.org, and you can see if they are registered. So with that, I'd like to thank everybody for tuning in, and everybody, it's a pleasure. I know this is as they call it, Holy Week. That's what Modestine said. She was late because it's Holy Week. So she was in service, and I hope you were being holy. So thank everybody. Joanne, what's up? Skinner, Garnett, Tracy, Denise Jackson. Thank you for tuning in again, Tracy. My little brother, Cole Chapman. What's up, babe? How you doing, man? My sister Gloria and Nolia, thank you, y'all. Linda must be doing Holy Week. Linda ain't on this week, y'all. She must be doing the Holy Week with the palm and the and let me stop. And Rodney Madison, the note experience. Oh, Rodney's got a new tag. His name is just not Rodney Madison Sr. It comes up the note experience. Yeah. Hope your business is stretching out, Rodney, because that's another investment alternative, holding mortgage notes where you're like a banker. And Modestine, what's happening down there in South Kakalaki? Modestine, it's been a couple of months now. We'd like to know, how is South Carolina treating you down there? And yes, thank you. That's everybody. Thank you for tuning in. We look forward next week, 144 dope. And next week is going to be April, isn't it? April the 4th. We'll be on. So look forward to seeing you at 8 p.m. And dope, what is that saying you shared with me today? It said, if you continue to carry the bricks from your past, you will end up building the same house. I love that. We'll end with that today. And by the way, though, I actually saw another one that said, bet on the future because it's going to happen anyway. All right, y'all, we are filled with knowledge here. We try to drop that. Dope. What was that sound? Bam! Dope and Bob dropping some knowledge. All right, see y'all next. Y'all take care. And happy, is it Easter this Sunday? Yes, Easter. Happy Easter, everybody. Don't eat too many jelly beans. Have a good day.